Hello, everyone. Welcome back to this week's Fast Track Money session. As usual, me, Yasi from Fast Track, and I will be with Matthias Richter this side, Matthias Richter from
Hi
Financial
everyone.
Engineer. If it's your first time here, I'm Yasi from Fast Track. So it's a content platform. We have a podcast called Fast Track Podcast. I have guests coming over to my show. We talk about entrepreneurship, we talk about money, we talk about career, so that you can learn the best practices and get the tips and fast track your life in those areas. And one of them is the topic is about money. Therefore, I have financial imagineer Matthias with me. He has his blog called Financial Imagineer, where he shares his personal experiences, how he achieved financial independence at age of 37, how he invests, what his money mindset, what his money habits. So the purpose is to help you to also build a healthy financial future and learn all the money skills that you never learned in school or at home. So today, as usual, we have one special topic. And today's topic is Matthias.
The topic is something I think as old as all the markets are. People usually try to time the market, and it is very interesting since we just started May. And the topic today is: should you sell in May and go away? There's a saying: sell in May and go away, but remember to come back. And then some people say to come back in September. Other people say to come back in November. And then some other people, they don't even say the second part. So it's simply go away. And today we want to look a little bit deeper into this topic. Yeah.
So why sell in May? Why not June? Why not April? Why not January?
Because it rhymes. It's so fun, right? It rhymes. May and go away, it rhymes. And actually, there is even science on this topic, which is super interesting. And if you actually think back, timing market is not something new. It's something that has been around for very, very long. And as long as we have stock markets, there have been people trying to kind of outperform or finding some patterns and trying to perform some magic. So in order to outperform and do better. And as you also may have heard, markets on the other side are usually rather efficient. But this sell in May and go away, it keeps coming back every year. So why we talk about this today, it's very, very simple, because this topic seems to be all over the media again. And actually yesterday, markets somehow start to go lower, right? Because it's May and people actually try to cash in. And there's a whole bunch of things that comes together with that topic, which we want to explore today.
It's funny how you talk about it, because yesterday I was looking at the market and then many of my orders got fulfilled. And I thought, okay, so fast, because usually I put the price lower than what it usually is in the last few weeks or a few days. And then the market tanked. And then I think about, oh, yes, tomorrow we are going to talk about sell in May and go away. Isn't it true that everybody is selling?
Yeah. So on one side, you have people who just ride the markets through all the ups and downs, right? And on the other side, you have these people that they have all kind of things. Sell in May and go away is not the only one. You have things about the Santa Claus rally, the January effect, the year-end rally. You have all kind of things like that. And actually, sell in May and go away is something more macro, because this one is not just like a 1 or 2 week thing or a 1 month thing. It's actually 6 months, the effect. And where does this come from? So you can think of a few years back, if actually the farmers, they sold all their things, right, in the beginning of the year. Then later they are busy. The summer is about to start and there's no more things to sell. And then as actually the real economy gets busy, the bankers can go for vacation. That's basically where it comes from. So this effect actually can be backtracked to the 1600s in UK, where they said the people who do business, they actually went back somewhere and try to enjoy their time off. Now in more modern times, there's a lot of things also connected to that myth, which is probably like when is the most money being spent in the economy? It's usually around Christmas. It's the holiday season. All the people spend money. That's usually when Black Friday starts in November. There's another seasonal effect where the holiday season starts. It's always like how much money more has been spent this Black Friday compared to before. And then the year-end rally usually gains speed. And also, people usually get their year-end bonuses at the year-end. That's why it's called a year-end bonus. And there, the money is actually available. So they have purchasing power. And there, if you get the money, you spend the money, then the engine is roaring. The economic machine is booming. That's usually the year-end effect. And then 3 months later, end of March, early April, you usually have the quarterly earning numbers, which will be released from that period. And no wonder at all. Usually these are the best numbers of the year. Not every year, but there is a pattern in that. And then after that, it will be very, very hard to beat these numbers. And then usually people say after May, you can go home, go away and let it go, right? So that's how.
Funny you mentioned about Christmas, because I was checking the Chinese market last year before Chinese New Year. I think even this year, yeah, before Chinese New Year, it was so good, at least the performance I've seen. And then I think around March, and it's negative, and April and May slowly gaining back the momentum. Maybe it's also because of seasonal effect. Like before that, people are engaged in the market, that the economy is booming, people are spending, business are running, and after that, they need to take a deep down.
Yeah, and now you have actually this pattern, and now the pure logic will be, okay, if you are an investor, why do you need to be invested from June to November, right, or October? Could it be that actually you take out the money for these 6 months and you are not invested at all, and you will be doing better than the people who stay invested, right? What do you think? Would that make sense?
For me, I'm not the timing the markets.
Okay, good. That's very good, because actually last year, just as close as 2020, if you look back, what has happened in 2020? If you have sold in like April, May, you would have lost the whole show. There was so much things going on. If you would have gone out there, well, you would have lost. Very simple. And actually, if you just invest the rest of the time, it would have been very bad for last year. However,
last year, this time should be the time you go into market and buy.
Exactly. So the first takeaway is every year is different. You cannot generalize it and say, oh, May to October is bad, and that's why we don't touch this time. Number two, actually, like I just mentioned, there has been a ton of research being made. They have been looking at the time series 200 years back, and the more updated or close time series I had a look at is going back to after Second World War. And if you would have not been invested from Second World War onwards during summer until now, you would have every year lost about 1.4, 1.5 percentage points. So it doesn't sound a lot, but if you look at it, number one, you wouldn't have lost money if you are invested. So all overall, it's still positive. So if you take the money out, what do you do instead of being invested? So you would have lost upside. Yeah.
Yes. So let me rewind back a little bit the story. So you said if people have invested from after Second World War onwards, the average return is 1.4%?
Yes, if you are just invested from May to October, every single year from Second World War to now.
You mean buy in May and sell in October, or buy in October, buy in
May? Buy in May and sell in October.
Oh, but then I would assume 1.4% would be lower than if you just keep holding.
Of course, the rest is much higher, but it gets more. So number one, the thing is, it is still positive. However, number two, like you just said, it's actually much, much, much lower, because the average, if you're staying invested all the time, you get about 10%. Roughly, right? I just approximated it. Sometimes it used to be 8, sometimes it's higher, roughly 10%. So that means the 8.5% is actually generated from November till April. And therefore, if you sell in May and go away, if you don't mind the 1.5%, you are not subject to the rest of the story. If you compound it, though, it would be something that you really, really miss out. However, at the end, the very tricky part is there is not a certain date where you can actually say, okay, 1st of May I sell, and then 30th of October I come back. 31st of October. No, it doesn't work like that, because sometimes actually the very day would make a big significant
difference.
impact. Yeah. So you would have to time the seasonality in it, and then you have to micro time within. And sometimes there's big things coming at that time, and if you are not invested, then you miss out. And
yes.
Yeah.
That's so funny. If you want to time the market, don't time the seasonality, but you have to time the micro, I mean, hours or minutes in order to really benefit from it.
You truly would require a crystal ball for that.
Yes, that's my next question is, does timing the market work?
Yeah. Timing the market, to a certain extent, you can say, yes, there is positive findings that actually, they call it also the Halloween indicator. Maybe I have something I want to share here. Let me figure out how can I screen share.
Every time I heard something interesting from your side, now it's the first time I heard Halloween indicator.
Yeah, it's called Halloween indicator. You see here, this is a study. Sell in May and go away, another puzzle. So there's actually a lot of people, very smart people, who spend a lot of time at universities to actually study these effects. And here, in this study, they actually say, yes, we document the existence of a strong seasonal effect. That means actually, this one is actually proven. It like in 36 out of 37 developed and emerging markets that have been studied in that sample, it means, yes, if you sell in May and go away, you actually would have skipped the worser part of the year. And they went back, you see here, all the way since 1694. And there's a lot of explanations they have looked at. So it's very, very interesting. On page 11, I found something that I want to show with you. It's actually going back to the old UK. The summer fall was caused by farmers selling and sowing their crops, and rich investors swanning off to enjoy Ascot, the Derby, Wimbledon, yalla yalla. Modern investors now, they are jetting off to the Mediterranean, where they cannot find copies of their pink papers, and senior fund managers soak up on the sun in the Caribbean cruises. So yeah, one thing, what is really, really true about that, the banker, all these market makers, usually around that time, they take time off as well. And therefore, you can actually say that during this time, there is much less action in the markets. There's less people following the markets, less people investing, less people making decisions. So the trading volume, in a way, goes lower. And therefore, if actually there is lesser people looking at the whole thing, the similar effect exists between Christmas and New Year. There's this 1 week where a lot of decision makers are not in their offices. And sometimes there, when a lot of people get very bullish and buy the market, things can go up very fast. So that's usually the year-end rally. And the opposite is in summer. If most of these people are off somewhere and don't care about the market, if something happens, the effects, the swings will be kind of magnified. So there's more action, more volatility, and less trading volume, and less experienced capital around to actually buffer the swings in a way.
Okay, from this study and all this, what I understand is that by studying the history, you see seasonality effect. But yes, for investors, if you want to take advantage of the seasonality effect, it's not that easy, because you have to know the future in order to time the specific days and the hours to leverage on it.
Yeah.
So the big trend does not transform into your timing the market profit.
Yeah, simply imagine you missed out on 2020 summer rally, and that's I don't know, but it could as well be the best rally we see in the 2020s. If you were not invested then, well, so be it, right? And if you're a fund manager and you have to provide and you actually are not invested at that time, people will see that for the next 10 years in your performance track record, right? So it comes with risks, with different risks. And very interesting is actually, so the limitations of this model are that even though we can definitely say, yes, there is seasonality, you need more than just saying, yeah, I sell in May and go away, even though it rhymes so nicely, right? So
there's another comment from Rose. He said, painful start of May is it should be buy in May and look away.
Oh yeah, I love that. Sorry, yeah, I didn't check the comments. So guys, anyone watching, feel free, Facebook or YouTube, you can hit your questions in the comment section, and we are here. It's an open Q&A session as well to answer and talk about your comments and questions. Please feel free.
And last time you mentioned in December, there's this year-end rally.
Yes.
Yeah, tell us more about that.
Well, that's usually the opposite, right? People in the US, you even have something called like tax loss harvesting, because you have to pay capital gain taxes in some countries. In other countries, you don't have to. But imagine you have to pay capital gain taxes, and you can actually weigh off, like you can let go of the losers, and you can put cash away, or you can actually realize some gains. So what happens usually is people clean up their portfolios towards the year end. And the same happens also in funds, actively managed funds, because end of the year is probably the most important snapshot of your portfolio. So it has to look very nice and neat. So that means in December, a lot of fund managers are doing like their window dressing. They're like preparing the fund to look super nice, that in January, when they show the term sheets, everything is cleaned up. So they get rid of the losers. So you're usually towards the year end, some of the weaker stocks, they trend lower because people like that will let go of them. And on the other side, you have actually the stocks with stronger momentum that will actually even get more buyers, simply because there's more capital available and people want to kind of balance their portfolios towards certain names and titles to make themselves look better.
So the loser stocks, and then they get rid of them, and then the freed up cash, and then they use the freed up cash to buy in more of the
eventually, yeah. Or some of them also wait, and then that's why in January, usually the first few trading days in January, people usually pump the cash back in also. So the fund managers, they clean up towards year end, and the private investors, subject to capital gain taxes, usually come back in January. And there you have a lot of purchasing power available in the market, and these people pump in money into good names. So there's the other effect. Early January, first week, usually the winning stocks keep winning.
And then in that way, should we as an average investor avoid buying winning stocks in January?
Well, again, right, that's in general, it works like that. But in order to really profit from that, you would have to, it's almost impossible, because usually the average investor has maybe 3 or 4 stocks like that. And then what if now this rule simply doesn't apply to that particular stock, but in general, it still works? Then you're screwed still, right?
Yes, that's true. Yeah. So rule number 1, try not to time the market.
It is the market. Right? Yeah.
I shouldn't say that. It's not a financial advice.
Time in the market usually beats timing the market, because timing the market requires more than simply, well, it's very impressive, right? If you look at all these studies, there's so much evidence that seasonality exists. But then the ultimate question is, okay, since there seems to be so much evidence on it, why nobody capitalizes on it? Why there isn't a sell in May and go away fund? That would be beautiful business, right? You can buy the fund, invest your money there, and half the time of the year, the fund managers can go on vacation. right?
Yeah. Yeah, that is the question. There is no answer.
Yeah, well, simple. It seems to be an effect there, but how to capitalize on it will then simply depend still on like which day to do what and what else happens. Usually, another thing is in the US you have election years, and usually during the summer times, the political situation is more uncertain. And towards winter, maybe October, early November, there's more clarity on who will win the elections. And then with clarity come new decisions, and then the whole thing gains momentum again, right? So that's the political overlay in that particular situation. Also interesting is the sell in May and go away effect is differently observed in different countries. So very interesting. In Europe, people take more vacations. So as a result, the summer months in Europe are usually much worse than in the US or in other places in Asia. It's super interesting, but you can actually see cultural habits flowing into macro charts that actually manifest in 50-year observations of data.
And also the northern hemisphere, and then
Yeah.
the southern part is like the seasonal effect is the opposite. Have you
Yes.
studied that, like in Australia, New Zealand?
Okay. I haven't looked at that. That would be an interesting thing to look at. But usually Australia and New Zealand, they also have the Christmas time, the holidays, right? So the bonuses will still be paid there, and the gifts will still be bought there. So
interesting. So any of the audience here, if you're watching right now live, have you tried to time the market? Have you tried to buy or sell on a certain date that you expect the market will go down or go up? Leave it in comment. Since we talk about do not time the market, who will say they time the market?
don't feel shy to write something. Maybe nobody. Well, there is also other effects. Like some people, they even find effects intraday. Like the beginning of the day, the lunch break, the afternoon session, and then the closing auction. You could find pattern in all kind of time series. It's super, super interesting. And a lot of them somehow, if you study it, it actually applies that it's true that there are some of these things that actually happen. But then the ultimate question is usually, can you consistently replicate it, and can you consistently profit from knowing what you see? And that's usually where it gets very hard. And if it were that easy, probably there would be a lot of people just doing that instead of spending time in the market and writing all the things, right?
But do you know, for in the finance world, funds or private professional investors, do they actually try to see the seasonality effect or try to time it this way, or they do it differently?
I think there are some people who shift like that. So I know some investors, of course, when you're subject to capital gain taxes, you will definitely do the thing at the year end. And there is also people, they have very disciplined approaches. If they have earned a certain percentage in gains, they rebalance. And then, of course, if the first 3 months are very, very good, they rebalance, right? Some people rebalance every month. And that's why you can see little effects of that at every month's end, because people, they sell the winners then at that time and maybe go to cash, or bonds used to be the big thing. But now with a lot of negative yields, it's hard to really look at bonds still, unless you have like different allocation into high yield bonds and maybe some more fancy things like get rid of your duration risk with some like derivatives. But all in all, I think, yes, people, they rebalance. And so, yeah, there is people who do that. And I have not seen, now I put it like that, I have not seen clear evidence that it's worth your while to do it. But of course, it feels good. What is definitely worth your while is the rebalancing. That's something you should do irrespective of knowing about these effects. because rebalancing is maybe I explain rebalancing quickly, if I may. I think we can explore that. So rebalancing is simply if you have, I start like that. You have one side, you have bonds or cash. On the other side, you have equities. Now you say the market is bad, your equities drop. Now month end comes, what do? You sell some of the bonds and you put it back into equities to make it back to 50-50. And now with this amount, since the market is lower for equities, you buy more equities. So you buy cheap. Maybe the next month, so you're back to 50-50 at that month. Next month, equities go higher. Now, what do? You sell the thing that is in excess of the 50-50 allocation that you want to aim at. You sell that and you put it back to bonds. You go back to 50-50. What do? You sell high. You sell high and you reallocate your money. And that's how, so if you look at portfolio allocation, we usually say your portfolio performance, 80% of it is derived by your kind of strategic asset allocation, not the tactical asset allocation. And if you have the strategic asset allocation correct and keep doing it with discipline, you actually do better than someone else with a similar risk profile that doesn't do this homework. We have a comment again. Thank you for that. Let's see, 2 scenarios one time. Major sell-off in an equity not connected to business performance, 2 indication of policy changes by the Fed. Yes, correct. So if you have things that have nothing to do with seasonality, then you're screwed. Like Corona hit us by March, April last year, right? And then all the Fed help came in after. It had to come in. They couldn't wait until I don't know when. So that's exactly the major limitations of that. And major sell-off in an equity not connected to business performance, that's usually when there is widely spread fear. It could be anything like what happens is in summer, you have much less trading volume. So usually these kind of sell-offs are more, like I said before, the swings are larger because there's less volume to pick it up, which also means if you actually are ready during summer and you see one of these swings and you actually go in, it is probably the best time to buy. Don't wait until November or September or whatever the rhyme ends at, right?
Right.
Yeah. So sorry, I cannot say yes or no. I just say yes, it exists. However, if you follow this effect, you will miss out. 63% of the years are still positive during that time. The average is 1.4 to 1.5%. You will not have that money. If you think that's okay, you can consider it. But then again, that's average over 50 years. I don't know what happens this year. I don't know what happens next year. Last year, if you would have done it, you would have missed out big time, probably the rally of the decade. So be careful with these things and do your homework. There's a lot of interesting studies, and I am actually writing a blog post on this, should be out later this week, and I will embed this video that we do today into this blog post, so it will be able to use together. Maybe the blog post, you can find it on my website later this week.
And then the last key message is, as you mentioned, I cannot agree more, is time in the market is much more important than time in the market.
Than timing the market, yes.
It's important, or you should, the time in the market is more important than time in the market, yes.
Yes, because I think some people, the smarter you get, the more information or access to information you have, the more you probably feel you can do something better than the others, right? And that's where the dilemma comes, because the more educated and you think you can do something, the harder it gets to actually stop these thoughts. And of course, you can try. And if you want to try, my advice is try with a smaller portion of your portfolio. Let's say you have 100. Don't go in with all your money in your trading ideas, but have like a steady core portfolio that is not timing the market, but this is here to stay for 10 years or more. And on the side, if you want to test your skills, why not? You please go ahead. You have a 20% allocation or something of your overall portfolio where you can test your ability. Maybe you're doing it well. I'm not saying nobody can do it. There have been some people who managed to do things like that. but usually it's a minority. And the other thing is like how much time you want to spend on that, right? So if it's something you really enjoy, why not, right?
Yeah. All right. Then let's come to the close of today's live session. I hope this discussion is interesting for you guys since we are at the beginning of May. You might have drawn a conclusion that should you sell in May and go away or not. And yeah, if you enjoyed this session, please give it a like, share it with your friends, follow the Fast Track podcast, and then check out the website financialimagineer.com, and you will find all the links in the show notes. If it's in YouTube, then YouTube description. If not, then in the comment section on Matthias' Facebook page. And lastly, we also started the third batch of the money course, and then if you want to join us, you can still sign up for the next batch. So now it's going to be opened in mid-June. So
yeah, it's exciting. We just started late last year, and we are starting now the fourth batch already. It's awesome.
Yeah. Thank you so much for being with us today. Thank you, Imrose, and thank you, the Rainmaker, and then all the others who are watching this, the replay, and hopefully to talk to you another session. Bye-bye.
Yeah. See you guys next week. Next week, the topic will be something around infinite growth. So the idea there is like you see the stock market growth. Can it grow infinitely higher and higher? Or are there some limitations to growth? And I think that's a super interesting thing, which we will cover next week. Hope to see you back. Thank you so much.